In the Fed's last policy meeting of 2023, policymakers said they would remain careful and data dependent in assessing policy decisions in the new year. So what does December's hotter than expected jobs report signal for the data points that will drive policy decisions in the months ahead? Joining us now to discuss is Eugenio Alemán, Raymond James Chief Economist. Eugenio, thank you so much for joining us. You know that the report came in certainly stronger than consensus, stronger than expected. You've had time to look over the report, Eugenio. Look under the hood a bit. What do you make of it?
Yes, thank you for the invitation. Yes, the report was much stronger than what we were expecting and what markets were expecting. But if you look at the report, inside the report, I mean, not every sector of jobs is growing. So, I mean, the addition to the jobs picture is constrained to or limited to 2 or 3 very, very strong sectors, including the U.S. government, which has gone on a hiding spree for the last year or so. So they are enjoying that there's not that much competition, and they are hiring a lot of workers.
Eugenio, it's Julie here. So when we look at the bigger picture here of what the Fed is going to be doing here, is it going to be focusing now more on the job market and potential slowdown as we are seeing inflation on this sort of steady relief trajectory?
Yeah, I think that the job market is still very, very strong. I mean, on average, the U.S. economy creates 120,000 jobs over history per month. We are more than twice that, or almost twice that figure. So the jobs market is still very strong. That creates issues for the Fed because it is always the case that the job market could potentially remain too strong for inflation going forward. For now, the signals from inflation is that the disinflationary process is ongoing and will continue. But in order to get to 2% target, the Fed needs to have inflation not to be higher than 0.15 for a sustained period of time, almost a year, with inflation below 0.15% per month. And we haven't been able to do that yet. I think that there are potential, the probability for to do that is down the road, but I don't think that the Fed is there yet. I mean, I think that markets are running ahead of what the Fed is willing to do right now.
And Eugenio, when we talk about sort of the trajectory of inflation and how it is cooling, it's moving in the right direction. But do you see, just as an economist, some potential upside risks to inflation in the quarters ahead, Eugenio? Whether it's easing financial conditions or maybe it's the housing market recovery.
Yeah, that is the biggest issue today for the Fed. How they measure and they weight what could happen if they have a recovery in economic activity, a recovery in lending. Because remember, this past cycle wasn't a monetary cycle. It was a fiscal cycle. It was a transfer of funds or incomes from the federal government to individuals and firms. And the Fed is trying to kill a fiscal cycle by using monetary policy, which is not the right thing to do, because it wasn't monetary policy that delivered this increase in inflation. So they are trying to buy time to allow inflation to continue to go down. But there are risks. There are risks in energy prices. The geopolitics of the world are in peril. So that could push oil prices higher and gasoline prices higher, and we know how determinant these prices are for the U.S. individual and consumer. So I think that the Fed is going to go slowly but surely. I don't think that March is a good date for them to start lowering interest rates. The real federal funds rate is at about 4.1%, so it's not that high in terms of historical averages. So I think that the markets are way ahead of themselves right now.
Eugenio, thank you so much for joining the show today. We appreciate it and have a great weekend.
Thank you. You too. Thank you.